Thank you for attending our presentation today. Nanny Taxes 2026, Handling Your Client's Household Employment. My name is Trevor Sparks with GTM Payroll, and we appreciate the time you're able to spend with us today as we know you're in the midst of tax season. A couple of housekeeping notes before we get started. If you have any questions, please use the questions functionality in the presentation console to submit them. We'll answer as many questions as we can during the presentation. If we don't get to your question, we'll follow up with you within the next day. And you'll receive an email after the presentation with a link to download the slides and a video of the recording. During today's presentation, we'll ask you 4 questions. You must answer at least 3 of these questions to receive CPE credit. As a reminder, this course is 1 CPE credit hour. If you successfully complete the course, we'll email you this certificate of completion within 5 business days. Here's an overview of what we'll go over today. We'll discuss the basics of when someone is a household employer, what happens as an employer, what obligations the employee has, what risks the employer has, what insurance is required, what's been happening with household employment and what's new this year, including paid leave laws, rising minimum wage rates, and labor compliance regulations, and how to convey the importance of compliance to your client when saying it's the law just isn't enough. At the end of this presentation, you'll understand your client's household employment tax responsibilities and how to manage them, new labor laws that are impacting household employment, what's new this year in household employment tax compliance, and how to explain the benefits of compliance to your clients, as well as the costly downside if they're caught not following the law. So at this point, I'd like to turn it over to our presenter, Mike Trucolo. Mike.
All right, thank you, Trevor. So before we get into what's new, I just want to take a step back and look at the basics of household employment. So starting with who is a household employer and who are domestic employees. For the most part, it is a family hiring a nanny to look after their children in the family's home. But we're also seeing more and more senior caregivers hired to help elderly loved ones age in place, as well as nanny shares, where one nanny cares for the family, or I'm sorry, the children of multiple families in one of the family's homes. They've grown in popularity as an alternative to daycare centers. We've come a long way since 1993, when President Clinton's nominee for Attorney General, Zoe Baird, was removed from consideration for the job because she and her husband had broke the law by employing 2 illegal aliens to nanny and chauffeur their child and failed to pay employment taxes. That prompted Congress to change the way household employment taxes are filed and to create the Schedule H, which shifted nanny taxes onto Form 1040. So we typically think of a household employee as a nanny, but anybody who works in someone else's home could be considered an employee. As we mentioned, senior care is a growing workforce. If your client privately hires a senior caregiver, either for themselves or an elderly loved one, such as a parent, instead of going through a home health care agency, that worker could be considered an employee of the senior or the family. Another area you may not think of is seasonal or temporary childcare. A babysitter with regular hours, a nanny hired just for the summer, or an after school nanny can easily earn enough for household employment taxes to kick in. Other household employees may include personal assistants, housekeepers, chefs, chauffeurs, and any other estate staff, as well as nanny shares. So when a family hires a nanny, it's straightforward who the employer is. But I just wanted to point out that there are a couple of additional wrinkles when hiring senior care. Your clients have a few options for finding senior care. How they bring the in-home caregiver on board will determine whether they are now the employers. A home health care agency will employ the caregiver to work in the senior's home, pay the employee, file taxes, and comply with tax, wage, and labor laws. In this case, the agency controls the employee's job duties. The agency will select the caregiver and send them to the senior's home. However, the senior may not always get the same caregiver. The agency is the caregiver's employer, so they control employment. A referral or placement agency recruits the senior care worker on behalf of the family. They charge a fee for this service and then hand over control of employment to the family, who is then responsible for payroll, taxes, insurance, and compliance. The caregiver is an employee of the senior or the family, and this is similar to a family hiring a nanny through a nanny agency. By doing it themselves, a family finds, recruits, and hires the senior care worker without the assistance of an agency. The family will also handle payroll, taxes, insurance, and compliance. So in this scenario, the caregiver is an employee of the senior or their family. A family may try to avoid household employment taxes by classifying the worker as an independent contractor. That way, they can give them a 1099 at the end of the year, and the employee pays the entire tax obligation. An independent contractor pays both the employer and employee FICA tax obligation, which is 15.3% of cash wages. And the family also avoids unemployment taxes and other responsibilities such as workers' compensation insurance. However, the IRS almost always classifies household workers as employees and not independent contractors. So that's not going to work. And here's why. It comes down to a matter of control. A family sets their employee schedule, tells them how to do their job, and the employee uses the family's tools and equipment. For example, a family with a nanny says your work hours are Monday through Friday, 8 a.m. to 6 p.m. The baby takes a nap at this time and is fed at these times. The nanny uses the family stroller for walks and their kitchen to prepare food. A nanny is not going to determine when they'll work, and they're not going to make up a baby's sleeping and eating schedule. The family controls the employment, and the nanny is their employee. And if there's ever any doubt, you can file the Form SS8 with the IRS and have the IRS decide on the worker's status. Just understand that employment misclassification is considered felony tax evasion.
All right, thanks, Mike. We're on to our first poll question. So these are the questions you'll need to answer throughout the presentation today. If you answer 3 of the 4, you're eligible for CPE credit. So our first question of the day, which of the following affects whether a domestic worker is classified as an employee or an independent contractor? So just answer right there on your screen, A, B, C, or D. And then that'll get you on your way to CPE credit. As a reminder, if you do have questions during the presentation, just use the questions box in the webinar console. Submit your questions there. We'll get to as many as we can at the end of the presentation. If we don't get to your questions, we'll be sure to follow up with you the next day and get you some answers. As a reminder as well, you'll receive an email after our time together today. That email will have a link to download the presentation as a PDF, a link to a video of this presentation, as well as a survey, so evaluation survey of the presentation. So we appreciate a couple of moments to fill that out. So looks like we have just about everybody in here. The answer is D, all of the above. All right, Mike, I'm turning it back to you.
All right. So one of the first steps in understanding nanny taxes is determining whether the employee's wages meet or exceed the employment coverage threshold for domestic workers. This is commonly called the nanny tax threshold. There is no coverage threshold for most industries, so every dollar of wages is covered and taxable. Household employment is one of the industries with an employment coverage threshold. The Social Security Administration sets this amount each year, and for household employees, it adjusts with the National Average Wage Index. The threshold for wages earned in 2025 is 2,800. This year's threshold will be 3,000. Use the 2025 threshold when filing a client's tax return during this tax season. So you can see how easy it is for a temporary or seasonal worker, such as a summer or an after-school nanny, to exceed that threshold and trigger nanny tax compliance. If a family goes over that wage threshold, they'll need to withhold and pay Social Security and Medicare taxes, which are commonly called FICA taxes. That total is 15.3% of cash wages, which is split evenly between the employer and the employee, with each contributing 7.65%. Employers can choose to pay their employee share and not withhold it if they want. Keep in mind that taxes paid to cover an employee's share of FICA must be included in their wages for income tax purposes. They aren't counted as Social Security and Medicare wages or as federal unemployment wages. You can report the Social Security and Medicare taxes paid in boxes 4 and 6 of the employee's W-2 form and add the taxes to the employee's wages reported in box 1 of the W-2. Don't count wages that are paid to a spouse, a child under the age of 21, a parent, or any employee that's under 18. For unemployment taxes, if cash wages to an employee is 1,000 or more in any calendar quarter, then the employer pays federal unemployment tax. That's 6% of cash wages on the first $7,000 of wages. An employer may also owe state unemployment taxes. They may be able to take a credit against their federal unemployment tax if they pay state unemployment. And it could be as much as 5.4%, which can really reduce the amount owed for federal unemployment. For unemployment taxes, the exclusions are spouses, children under the age of 21, or parents. So just to review a couple of key points. Household employment tax responsibilities kick in when the 2,800 in cash wages threshold for 2025 is met, or 3,000 for 2026. The family pays 7.65% of their employees' pay in FICA taxes, and they also pay federal and state unemployment taxes if applicable. For the employee, they also owe 7.65% of their pay. This is required to be withheld and remitted by the family. Again, the family can choose to pay this on their employee's behalf instead. Either way, the employer is responsible for remitting the employee's portion of FICA taxes. Federal income tax does not need to be withheld, only if the family wants to. However, it's a good idea to withhold it so the employee is not stuck with their entire income tax bill at the end of the year. If a family does decide to withhold income tax, they'll need to provide their employee with a Form W-4 and a state withholding form. That'll determine how much to withhold from the employee's pay for income taxes. State and local taxes, if applicable, will obviously vary depending on where the employee lives. So we know what is owed, but how are these taxes remitted? So there's two ways that you can do this. The first way is probably the best way to do it. You remit the household employment taxes quarterly using Form 1040-ES, then detail the annual amounts paid on the Schedule H. If your client prefers, they could increase withholdings from their own pay to anticipate this increase to cover their household employment taxes. You should do one or the other. If their nanny tax obligation is large enough, your client may wind up owing taxes when they file and possibly be subjected to an estimated tax penalty and interest for underpaying taxes during the year. And with that, Trevor, I will turn it to you for the second poll question.
Okay, thanks, Mike. The question should be on everyone's screen right now. An employer can choose to pay the employee Social Security and Medicare tax responsibility, 7.65% of gross pay. Just answer A or B, true or false there. This is the second of our 4 poll questions. Again, answer 3 of the 4 questions. You don't have to be correct, you just have to answer them. Answer 3 of the 4 and you're eligible for CPE credit. Those certificates will be emailed to you within a few days after the presentation today. Expect it within 5 days. So if you have any questions for us on the content of this presentation, just use the questions module in the webinar and we'll get to as many questions as we can today. If we don't get to your question, we'll be sure to follow up with you and get some answers for you. So I'm just looking to see if a few more people are coming in. Yep. All right, looks like we have just about everybody in. And the answer here is A, true. All right. And Mike, I'm turning it back to you.
All right, so let's talk some paperwork. So here are some of the forms that are needed as a household employer. The SS4 to apply for an EIN, which can also be done online as well. The family will also need to be set up as an employer with their state and file a new hire report. They'll also obtain a Form I-9 from their employee, which we'll get more into in a moment. If they do decide to withhold income taxes, they'll also need to obtain a W-4 and a state withholding form from their employees. So a little bit about the I-9. Families with household help must collect the I-9 from their workers at the start of their employment. We've all filled this out when we've started a new job, and it's no different for nannies, housekeepers, and senior caregivers. As a reminder, the I-9 confirms a worker's identity and authorization to work in the U.S. They can submit a document from List A to prove identity and employment authorization, or documents from List B and C. The I-9 must be signed no later than the first day of employment, and the documents must be presented within 3 business days from the start of employment. A family needs to inspect the documents, make copies, and return the originals to their employee. The documents must reasonably appear to be genuine and relate to the employee. Copies of the documents are kept in the employee's personnel file with the I-9, and they are not returned to any government agency. Employers must retain the I-9 for either 3 years after the date of hire or for 1 year after employment is terminated, whichever is later. The I-9 form can be completed electronically to help reduce errors, and it's available on the U.S. Citizenship and Immigration Services website at uscis.gov. At year end, the employee needs to receive their W-2 by January 31st. Since that fell on a Saturday this year, they were actually due on Monday, February 2nd. Also, Form W-3 and Copy A of Form W-2 must be submitted to the Social Security Administration by that same date, and then Schedule H is filed with the employer's personal tax return. So what we've covered so far is basic tax withholding responsibilities. Now we'll get into some of the labor, tax, and payroll nuances surrounding household employment. Some of these are state specific, like a domestic workers' bill of rights, and there are also rules around overtime pay, live-in workers, sleep time, and companionship care. And in a growing trend, many states and cities have paid leave requirements impacting household employers. So what is a domestic workers' bill of rights? These laws bundle domestic worker protections, which could include minimum wage, overtime pay, paid time off, days of rest, and more. In New York, for example, household employers must give 1 day of rest for every 7 days and provide written policies on sick leave, vacation, and work hours, 3 paid days off after a year of work. They must pay on a weekly basis and need to provide a pay stub even if the employee is paid electronically or by direct deposit. Massachusetts is similar, and there are protections for mandated amount of rest time depending on the hours worked, written work agreements, and more. If you have clients with household employees in any of the states or cities with domestic worker protections, you'll want to familiarize yourself with these obligations. The first Domestic Workers Bill of Rights took effect in New York in 2010. And since then, several other states and the cities of Chicago, Philadelphia, Seattle, and Washington, D.C. have enacted similar laws to grant basic labor protections to household employees. As a heads up, domestic worker protection legislation has been reintroduced in the state legislature in Washington, so we're keeping a close eye on that. You'll hear us say this frequently during the presentation, but noncompliance is costly. Here's just one example from New York. If your client violates the state Domestic Workers Bill of Rights, which requires weekly pay for household employees, they can be sued for up to 300% of delayed wages, plus attorney fees and interest. So again, it's important to review the domestic worker protections in your state and city. The FLSA, which is the Fair Labor Standards Act, includes household employees. Domestic workers must be paid at least the applicable minimum wage rate. The federal minimum wage is $7.25 an hour, and that hasn't changed for quite some time. However, many states, counties, and cities have enacted higher minimum wage rates than the federal rate. In California, for example, the minimum wage rate is $16.90 an hour, which supersedes the federal rate and becomes the applicable rate. However, dozens of cities in California have higher rates than the state rate. Los Angeles is now $17.87 an hour, and San Francisco is $18.67 an hour. So those local rates apply. And just to make it even trickier, many states have built-in increases to their minimum wage rates. You'll need to pay attention to this if your client is paying their employee minimum wage or close to it, as their hourly rate may quickly violate wage laws. According to the FLSA, household employees are non-exempt workers. That means they must be paid hourly rather than a fixed salary. This also means household employees receive time and a half in overtime pay for hours worked over 40 in a 7-day work week. Live-in employees and caregivers who meet the companionship care definition may be exempt from overtime, and we'll get more into those situations in a moment. California is a little bit different. Time and a half kicks in after 8 hours a day, 40 hours a week, and the first 8 hours worked on the 7th consecutive day of work in the work week. Your clients with household help should maintain records of hours worked and pay to ensure that they are meeting minimum wage and overtime rules. So this is where many household employers get into trouble. They'll forget to track hours or pay and wind up getting sued by a disgruntled employee who seeks back wages because they weren't paid properly. Later on in this presentation, we'll get into the new no tax on overtime. So live-in employees, you'll see this a lot with nannies or seniors who need around-the-clock care. Up to 8 hours of sleep can be unpaid if certain criteria are met, and 5 hours of continuous sleep is a big one. If a live-in nanny is expected to be on call during the night and their sleep time is interrupted to care for a child, even if it's just for a few minutes and they don't get at least the 5 hours of uninterrupted sleep, then the entire 8 hours of sleep time is now paid. The exception to this is California, which doesn't allow sleep time to be unpaid. As for overtime, federal law exempts live-in employees from overtime pay. However, some states, such as New York, now have their own overtime requirements for live-in employees, and those supersede federal law. In Minnesota, overtime for live-in employees will start at 48 hours, and Oregon, like New York, will start at 44 hours. In Hawaii and Maryland, live-in employees need to be paid overtime for hours over 40, so they're not excluded from overtime laws in those states. Companionship care. This is a key consideration in senior care. If a caregiver falls into the companionship care exemption, then they do not need to be paid overtime for hours worked over 40 in a work week. If they don't have the exemption, then they'll need to be paid overtime. The work is defined as things necessary to care for an elderly patient. Bathing or dressing the patient, cleaning, and cooking are some of those activities. Only 20% of a caregiver's work time can be spent doing these sorts of activities to qualify for that exemption. That means the rest of their time is spent with fellowship and protection. They can be watching TV, doing puzzles, playing cards, or doing whatever it is that's not necessary to care for that elderly patient. It's also important to know the exemption doesn't apply to caregivers that are hired through a third party. So if a family thinks that they can take advantage of the companionship care exemption, hiring privately and not going through a third party could be a big financial benefit. There's a growing trend for paid family and medical leave at the state level, and many of these programs include household employers. There are more than a dozen states with laws requiring paid leave, and we've listed several of those here. California, Colorado, Connecticut, Illinois, Massachusetts, Michigan, Minnesota, New York, New Jersey, Oregon, and Washington are all active, meaning that household employees, if eligible, can take leave for qualified reasons. In Minnesota, contributions to the state's paid family and medical leave program began in January. However, employers are required to submit quarterly wage reports to the state for PFML purposes. That started on October 31st. Employers were also required to provide written notice to employees by December 1st. Localities such as New York City, Chicago, Pittsburgh, and Washington, D.C. also have paid leave requirements. On January 1st, Pittsburgh's Paid Sick Days Act increased the number of paid leave hours available to employees from 24 to 48 hours a year. Paid leave laws often apply to all employers, even those with just one employee, such as a family with a senior caregiver or a nanny. These programs may require a small employee contribution through a payroll deduction, or your client can cover that contribution for their employee. So it's important to review any paid leave laws in your state and determine whether they apply to household employers. If they do, you'll need to follow the contribution rules if required. So we mentioned earlier that families may try to classify their employees as independent contractors to avoid their tax obligations. Another way to avoid responsibilities is to put a nanny or senior caregiver on the company payroll, which doesn't work with the IRS either. It's considered an illegal tax deduction because all employees on a business payroll must directly contribute to the business's success. But of course, there is an exception. A sole proprietor of a business or farm with household employees can report their household payroll taxes on their company's Form 941 or 943 for farmers for ease of filing. That doesn't mean they can put their household worker on their business payroll. It just means that they can report the taxes on the 941 or 943. Even with this exception, for simplicity, it may be best to keep the household payroll taxes separate from your business-related taxes. File Schedule H for household and Form 941 for businesses, or Form 943 if that business is a farm. Outside of that one exception, don't use the Form 941. The 941 and not Schedule H is a common way that accountants may handle household payroll and make mistakes when reporting household employment taxes. This misstep can make more work for you, increase the risk of penalties, cause dual reporting to the IRS, and create other accounting issues. The Schedule H was created specifically for household employers to report wages paid to their employees during the year. It's an annual filing that's prepared with your client's personal income tax return. The 941, however, is filed every quarter, even if your client didn't pay an employee during that period. So if you fail to file the 941, even without any payroll to report, your client will likely incur penalties. You should keep copies of the Schedule H and other employment tax forms filed, as well as the W-2, W-3, and W-4. For unemployment tax purposes, you should retain the total amount of employee compensation, amount subject to unemployment tax, and state unemployment contributions. You'll want to keep payroll and tax records for at least 4 years after the due date of the return on which you report the taxes, or the date that the taxes were paid, whichever one comes later. Unemployment tax records should also be retained for 4 years after their due date or the date the unemployment tax was paid, again, whichever is later. Most states have a 2-year statute of limitation on lawsuits filed by former employees, so you'll want to keep documentation for at least that time period. And for auditing purposes, you may want to maintain tax and payroll records for up to 7 years. In any case, it's always a good idea to maintain employee tax and payroll records for longer than you think you'll need them. So those are the basics when it comes to tax, wage, and labor laws for household employment. I also want to highlight liability insurance, as this can be one of the costliest mistakes that a household employer can make, and an easy way for a family to get caught if they're not paying their employee on the books. So you never know when an injury might occur. Whether it's around the house, driving the kids in the car, or walking the dog, unforeseen risks are always in play. Household employers in many states are required to carry workers' compensation insurance for employees who get hurt or sick on the job. That'll help pay a worker's medical expenses and lost wages. Without the required coverage, a family could face thousands of dollars in fines and penalties and a possible lawsuit to recoup those lost wages and payment for medical expenses. So even if workers' compensation is not required, it may be wise to get voluntary coverage just in case. So, who benefits from workers' compensation? Both the employee and the employer are protected by workers' compensation. Some of the employee's medical bills and lost wages will be covered, and employers will likely avoid a lawsuit. This kind of protection can easily be worth tens of thousands of dollars for your high net worth clients. So a popular question we get at GTM when the topic of workers' comp comes up is, doesn't my homeowner's insurance cover this? The short answer to this is no. There's a difference between somebody visiting your home, slipping and falling, or even a worker like a plumber or an electrician getting injured while working in your home, versus having somebody employed in your house for 20, 30, 40, or sometimes 50 hours a week. Never assume that an employee is covered under the homeowner's insurance. The exceptions to this are New Jersey and California. In New Jersey, you can add a rider for workers' compensation to your homeowner's policy, which is substantially cheaper than a standalone policy. And in California, it's actually required to have workers' compensation on your homeowner's policy if you have any kind of household employee. So this is what we mean by not having the required workers' comp is one of the costliest mistakes that a household employer can make. Fines can be as high as $5,000 every 10 days of noncompliance, which is about $15,000 in a month. So it's not uncommon for fines to quickly reach tens of thousands of dollars. The GTM Insurance Agency, which is an affiliate of GTM Payroll, will receive calls when a family is looking for coverage because they were caught without a policy or their employee was injured. Once, a family came to us after getting a $120,000 fine for not having the required coverage in place. So again, looking at workers' comp rules in your state is important. And we've listed the states where it's required for full-time, part-time, and full-time only workers. So how does somebody get caught? So this happened in Connecticut to a family that was paying their nanny off the books. Their nanny fell down the stairs while carrying a baby, and the baby was okay, but the nanny had injured her back. She went to the doctor, and the doctor asked, "Well, how did this happen?" The nanny responds, "Well, I was working." So it instantly becomes a workers' compensation case, even if it's unintentional. Because of this, the nanny missed several weeks of work. She expected her medical bills to be paid and to receive her typical pay while she recovered. The family didn't want to pay her because they're already paying for another caregiver to cover for that injured nanny. So a couple of things happen here. The family was exposed for paying their nanny illegally. And why? Because they didn't have workers' compensation. This family dealt with back taxes owed, plus fines and penalties on those back taxes. And they dealt with fines for not having workers' compensation, which in Connecticut is $300 a day for every day that you go without coverage. So you can see how quickly that adds up. On top of that, the family paid the employee's medical bills, lost wages, and a fill in nanny, and they also had to find another employee as they had damaged the relationship with their nanny. And on that note, I will turn it to you, Trevor, for our third poll question.
Okay, thanks very much, Mike. Third poll question is on everybody's screen. Workers' compensation insurance protects employers from which of the following risks? Just answer right there on your screen, A, B, C, or D. This is our third of four questions, poll questions in this presentation. You'll need to answer 3 of the 4 to be eligible for CPE credit. If you have questions about the material we're covering in this presentation, feel free to use the questions box in the webinar console, and we'll get to as many questions as we can during our time we have with you today. If not, we'll definitely follow up. We'll also have Mike's contact information later on in the presentation, so you can reach out to him directly if you have any questions, especially this time of year. We definitely get a lot of household employment compliance questions as tax forms are being filled out and filed. So you'll have that. You'll also get an email after the presentation that will have a link to download the presentation as a PDF or watch a video of the presentation, keep it as reference. And then there's also an evaluation survey in that email. If you can take just a moment to fill that out, we would appreciate that as well. All right, it looks like we have just about everybody in. And the answer here is both A and C. All right. I'll take care of that. And Mike, we're turning it back to you.
All right. So now let's take a look at some updates in the household employment industry. So the One Big Beautiful Bill Act was introduced, and it introduced the no tax on overtime rule. While it doesn't change how you or your clients run payroll, it directly affects an employee's federal income tax liability. Federal income tax will no longer apply to the overtime premium portion. That's the half of the time and a half of certain qualifying overtime wages. This change is retroactive to January 1st of 2025. To benefit from this deduction, the overtime must meet the requirements of the Fair Labor Standards Act. For household employment, this applies only to live-out employees, and the employee works over 40 hours in a 7-day work week. If an employee is paid $20 an hour, then their overtime rate is $30 an hour. That extra $10 an hour is the overtime premium, and it's not subject to federal income tax. Remember, live-in employees are not required to be paid overtime under the FLSA. The state laws we discussed earlier regarding live-in employees and daily overtime don't apply here. It's just what's federally mandated by the FLSA. Also, double time, holiday pay premiums, or guaranteed overtime hours that are not directly tied to FLSA mandated hours don't apply. While your client still must pay these amounts based on state law or their employment agreement, the employee cannot claim the federal tax deduction on those premium payments. The employee can deduct up to $12,500 for individuals or $25,000 for joint filers. The deduction will be claimed when the employee files their personal tax return. This deduction does not impact Social Security, Medicare, or state income taxes. Those contributions remain exactly the same. The IRS has provided penalty relief to employers for no tax on overtime due to not filing correct information returns or providing correct payee statements to the employees. That means employers will not face penalties for failing to separately provide a total amount of qualified overtime compensation. That relief is limited to returns and statements filed and provided for tax year 2025. Also, Form 2 or W-2 for our 2025 tax year was not updated to account for the One Big Beautiful Bill related changes. So, tax year 2025 will serve as a transition period for IRS enforcement and administration over the new information reporting requirements for qualified overtime compensation. The IRS has encouraged employers to provide employees with a separate accounting of overtime compensation so that employees have the information necessary to claim the deduction for qualified overtime compensation for 2025 taxes. Employers can make the information available to their employees through additional written statements or add qualified overtime compensation in box 14 of the employee's W-2. The tax reporting rule for mobile payments is being phased in. Employees will receive a 1099-K form this tax season if last year's reporting criteria of 2,500 in transactions were met. The threshold will be lowered to $600 this year, reaching the statutory level. The reporting rule may change how your clients pay their nannies and their babysitters. So payments for goods and services like babysitting or childcare through third-party settlement organizations such as Venmo, PayPal, and Cash App were reported to the IRS if those transactions total 2,500 or more. The intent of this requirement is to target businesses that use these apps to circumvent banks and traditional income reporting. The IRS wants to make more transactions reportable so that it's harder for businesses to underreport their taxable income. Unfortunately, with this, household employees are getting swept up in it. Families that employ full or part-time household help, such as nannies, in-home senior caregivers, and housekeepers, may want to avoid using mobile payment platforms to pay their workers. Those workers will likely receive a 1099-K from the IRS and a W-2 from their family, which can cause some confusion when they file their taxes. Paying for a date night or occasional babysitter through a mobile app may still be acceptable, but those sitters should know that this income will likely be reported to the IRS and should be reported on their personal tax return. It's always been a requirement to report the income when net earnings from self-employment exceed $400. This new rule just broadens the reporting of the tax information to the IRS. So remember, this is not a new tax, it's just a new reporting requirement. A seemingly easy way to circumvent the new rules may be to pay a babysitter through a personal transaction, as if they were a family member or a friend. However, if you pay that babysitter regularly, those consistent transactions will raise red flags with the payment platform and call into question whether those payments were actually made to a family member or a friend. And in fact, PayPal, who also owns Venmo, says it will monitor accounts to ensure that personal payments are not used to pay for goods and services. So it is always best to pay a babysitter as a service transaction. A best practice would be to pay a full-time nanny or employee by direct deposit or check. So here are the contribution limits for certain employee benefits for the 2026 tax year. Contributions are made on a pre-tax basis, which can reduce the amount your client and their employee owe in taxes. Plus, offering benefits is a great way for your client to retain top workers and attract the best candidates. So here are some of the key contribution limits relevant to household employment. So I just want to highlight that the QSERA, which stands for the Qualified Small Employer Health Reimbursement Account, this can help an employee reduce their healthcare costs tax-free. And it's for employers with less than 50 employees as long as they don't already offer a group health insurance plan. So this is perfect for families with household help. Employees are reimbursed for health insurance coverage purchased on the individual market or through the healthcare exchange, and for out-of-pocket medical, dental, and vision expenses. These QSERAs are funded by the employer and these contributions are not taxed for the employer or the employee. Reimbursements are also not taxed as long as the employee has a health plan that meets minimum essential coverage. A dependent care FSA, sometimes referred to as a dependent care assistance plan or DCAP, is a pre-tax benefit account offered by employers and used to pay for qualified out-of-pocket dependent care expenses, such as a nanny's wages. By putting money into a dependent care FSA, your client will reduce their overall tax obligation as funds are withdrawn from their pay and placed into their account before taxes are deducted. It lowers their taxable income, both for income and FICA taxes, so your clients end up paying less in taxes. For 2026, the maximum annual contribution for a dependent care FSA will increase to $7,500 per household or $3,750 for those married filing separately. This change was part of that One Big Beautiful Bill Act, which provides a permanent but not inflation indexed increase to the contribution limit for the first time since 1986. As we've discussed, household employees must be paid the highest applicable minimum wage among federal, state, and local rates. State and local rates have been on the rise. Many states and cities are making annual incremental increases until they hit $15 an hour or more. So this is just a sampling of states and other jurisdictions that are popular for household employment and increased their minimum wage rates on January 1st. Some new and upcoming paid leave programs have requirements to be aware of. In Minnesota, employers can begin deducting the employee's share of paid leave, and benefits were available to employees starting on January 1st. Employers must file quarterly wage detail reports. The first one was due on October 31st. This information is submitted using the existing state unemployment insurance system, and the quarterly wage detail reports submitted for paid leave are identical to the wage detail reports employers currently submit for unemployment insurance purposes. Maryland has delayed the implementation of its family and medical leave insurance program. Payroll deductions won't begin until January of 2027, and employee benefits won't start until at least a year later. Retirement plan requirements are also starting to take hold across the country. Most state laws likely won't apply to household employers because of the minimum number of employees that are required to qualify. However, California has now lowered the threshold for its retirement plan requirement to just one employee, which is down from five. So your clients in California must enroll for CalSavers or sponsor a qualified retirement plan on their own and report that to the state. Maryland's law is new and starts with just one employee. However, your client must have been a household employer for at least 2 calendar years to qualify. And again, clients can enroll in the state program or just sponsor a retirement plan of their own. Looking ahead, Hawaii will require all employers to offer a retirement plan by the end of this year. So I'd like to wrap up with some of the benefits of being compliant. We've already talked about the first three benefits on this list. It's lowering your risk and avoiding trouble with the IRS, workers' compensation boards, and disgruntled employees. A client can also take advantage of those tax breaks, which may be more than their nanny tax obligation. For an employee, they'll have a legal employment record and verifiable income, which can in turn help them with getting a loan, mortgage, or a line of credit. If a nanny wants to buy a home or a car, it's better that they're paid legally. They can also get unemployment benefits if they are let go through no fault of their own. They're also protected by workers' compensation if they're injured on the job and in states with disability insurance requirements. They're protected for injuries outside of work. With senior care, you can look to reduce costs through long-term care insurance and veterans benefits. To take advantage, you may need to provide payroll information and caregiver activity logs, so the caregiver does need to be paid legally. Your client may be able to deduct expenses they paid during the year for medical and dental care for themselves, their spouses, and their dependents. IRS Publication 502 has more details on that. With a medical care or healthcare FSA offered through your client's employer, They may be able to pay their elderly loved one's medical expenses that aren't covered by insurance. The senior must qualify as their dependent. If the person receiving care lives with your client, is physically and mentally unable to care for themselves, and requires a caregiver to care for them so that your client can work, then your client may be able to pay some of the senior's care expenses with a dependent care FSA offered through their employer. The senior may also be a qualifying individual under the Child and Dependent Care Tax Credit. The senior must be physically or mentally incapable of self care, have lived with your client for more than half of the year, and be either their dependent or could have been their dependent under certain exceptions. These are potential options for your client to reduce their tax obligation and reduce their costs as a household employer. I will turn it to you, Trevor, for our final poll question.
All right, thanks, Mike. Our final poll question is up on everyone's screen. What are the benefits of being compliant with domestic payroll laws and regulations? So answer right there on your screen, A, B, C, or D. This is our final poll question of the presentation. So if you answered 3 of the 4, you are eligible for CPE credit. We're winding up the formal presentation, just a few more topics to cover, a couple more topics to cover, and then we'll get to your questions. We have a few that came in during the registration process, and we have a couple others to get to. So we'll get to as many of those as we can before the top of the hour. If we don't get to your question, we'll be sure to follow up with you in the next day and get you some answers. You'll also have Mike's contact information. We'll have that up on the screen later on, and you'll be able to contact him at any point if you have any questions about household employment compliance. You'll also receive an email by the end of the day that will have a link to download this presentation as a PDF and a link to watch a video of the recording, save that as reference, save the PDF as well as reference for this tax season. And then there'll also be an evaluation survey that if you can just take a quick moment, it's a quick 5-question survey. If you can do that for us, we'd appreciate it. So, all right, looks like we have everybody in, and the answer here is D, all of the above. All of those are the benefits of being compliant. All right, Mike, handing it back over to you.
All right. So if you have a client with a household employee, these are the steps that you or they need to take to be compliant. They'll need to file federal and state unemployment taxes every quarter and prepare W-2s, W-3s, and Schedule H at the end of the year. The last point here could be the most important. Tax, wage, and labor laws are constantly changing. We've talked about paid leave laws, minimum wage rates, and domestic workers protections, and more are coming. So it's important to monitor changes in the law that may impact your clients with household help. Don't procrastinate. We can't emphasize this enough. Household employment compliance is not something that you'll want to handle at tax time. You have enough going on, and you don't need a client to tell you in January that they hired a nanny that previous year and haven't been withholding taxes. You'll then have to go track down hours and wage information to make sure minimum wage and overtime rules have been followed for the year. And that's the last thing you'll want to be doing during your busy time of the year. It's much better to get on top of this at the time of hire. Also, keep in mind, workers' compensation needs to be in place before the employee starts working. And again, those fines are daily, so it's important to get them set up beforehand. And on your screen here, it's a list of resources available, including publication 926, which is essentially the IRS Bible regarding household employment. We've discussed using Form SS8 if you want the IRS to tell your client that their nanny is an employee and not an independent contractor. Form W4 is needed if your client will withhold income taxes from their employee's pay. So I'd like to thank everybody for attending our presentation today. I do hope that you found it valuable. We do have some time for a few questions now, but if anything comes up while you're handling nanny taxes or household payroll, please don't hesitate to contact us. We are more than happy to help. And with that, I will turn it to you, Trevor, for the questions.
All right, thanks very much, Mike. Our first question, are there new tax forms for the 2025 tax season?
Yep, so there is one new form for this tax season. If an employee is going to claim the no tax on overtime or one of the other new tax deductions, they'll be filing a Schedule 1A with their tax return this year. For your clients, the standard forms related to household employment will remain the same. You'll provide the employee with a W-2, file W-3 with the Social Security Administration, complete Schedule H with your client's return, and Form 2441 if they're claiming the child and dependent care tax credit. The only nuance for you and your clients this tax season is the option to report overtime on the employee's W-2 in Box 14. For next tax season, the W-2 will look a little different. There will be new codes for in Box 12 for qualified overtime compensation, cash tips, and employer contributions to the new Trump accounts.
All right, so we'll worry about that at the end of the year. We'll get through 2025 tax season right now. All right. Are there any problems when an employer doesn't give a W-2 to their employee?
Yes. So the employee needs a W-2 in order to file their personal tax return. If they tell the IRS that they didn't get one, your client will immediately get a call from the IRS. And I don't think we have to be the ones to tell you that it's a good idea to avoid those kinds of phone calls.
All right, absolutely. All right, our next question. What are the rules and reporting requirements if wages are below the nanny tax threshold?
So if a household employee's wages were below 2,800 for 2025, then there is no FICA tax reporting. It doesn't need to be withheld, and there's essentially no employer responsibility. Your client doesn't have to issue a W-2 or file the Schedule H in this case. The employee would still need to report the income when they file their personal tax return. And there could be a federal unemployment tax if the employee earned $1,000 in a calendar quarter. If that's the case, then your client would need to pay that tax as its employer only and file Schedule H with their personal return. There could be state unemployment taxes as well, and those obviously vary by state. And there's also, even for workers' compensation requirements, depending on the number of hours worked or the wages that are earned. So in these scenarios, you'll definitely want to check on your state rules on unemployment and workers' compensation.
All right, Mike, we have one more question here, and that will wrap things up unless another question comes in, but this might be our last one. How do you report on Schedule H when your client has multiple household employees?
Sure. So you'll enter everything in aggregate. So for example, box 1A asks for total cash wages that are subject to Social Security. The wages that you enter in that box are total wages for all employees. So you'll only file one Schedule H, and that will cover all of your employees. So you won't have to file a Schedule H for each individual employee that you have.
All right. Thanks very much, Mike. That's all the time we have. If we didn't get to your question, we'll be sure to follow up with you by email or phone. You have Mike's contact information right there. Feel free to email him or call him if you have any questions at any point, but especially during tax season. If you have any compliance questions, we'll be happy to help. As a reminder, you'll receive a PDF copy of this presentation by email later today. If you're eligible for CPE credit, which means you participated in at least 3 of our 4 poll questions, you'll receive a certificate of completion by email within the next 5 business days. So again, if we can be of any assistance to you or your clients, please don't hesitate to reach out. We'll be happy to help. And once again, thanks for joining us today, and best wishes for a successful tax season. Thank you.